Hey guys, Michael Beresford here from Open Wealth Creation. I'm stoked. It's made my day. Cam and Al have asked me to take on the next few wealth WODs. They're busy doing CrossFit. I've been working out and ready to share some things with you. So one of the things that we get asked a lot is around tax and how you can maximise tax benefits with property. Now, standard disclaimer, I'm not an accountant, so in terms of what you can claim, please check that with your accountant. But as a general rule, every expense with an investment property is tax deductible, except the stamp duty on the purchase and the legal costs in terms of the conveyancing to affect the purchase. So as a general rule, that's what you can claim. With regards to how you can maximise tax benefits, though we all pay a lot of it, we want to get it back in our pocket as best as possible. There are two key ways to do it. The first is through depreciation. So if we've bought new cars, and we've obviously heard the saying that the car loses $5,000 worth of value as soon as you drive it out of the showroom, that's not theoretically correct, but the point is that assets drop in value over time, and houses are no different. Now, that dropping in value over time is what we call depreciation. And depreciation are additional tax deductions that you can claim. So if we think about it, you might spend $450,000 on an older property, no depreciation if it was built before 1985, July 1985. Or you could buy a brand new property for the same amount. This one here is giving you so much more in tax benefit as a result. Now, on a typical kind of $450,000 property, your depreciation is going to be about ballpark 10 grand in the first year, and then drop slightly over time. Now, if you're getting $10,000 extra tax benefits, and you earn $80,000 and pay a 30% marginal tax rate, then that's an extra 3 grand back in your pocket in terms of tax benefit. Now equate that to a weekly cost, that's $60 a week. And if you buy the right kind of property, $60 a week is all it costs you to be able to hold another property. So buying old or buying new might not sound like a big difference, but if you get smart about what you buy, you maximise your tax deductions through depreciation, and you can hold a second property for the same net cash flow, then your wealth creation's really going places. Okay, so that's why it's so important to maximise tax benefit in general, and specifically depreciation's a way of doing that. Now, I want to share with you a really funky tool that most people are not aware of when it comes to actually getting that tax back in your pocket. And it's called a tax variation form, or a PAYG withholding form. Basically what that is, it allows you to get your tax benefit fed to you throughout the year. So a really simple example, let's say that your property portfolio gave you $12,000 annually in tax back. Now, there are two ways that you can claim it. The first is through a lump sum. Now, this is the way that most people do it. You get $12,000 back in your tax return. You're covering additional costs throughout the year, but you get that back from the ATO once the tax return is done. The far better way to do it is with the tax variation form. Very easy to set up. You or your accountant can do it. Your payroll department gets notified of what the new tax rate is, and let's keep it simple and say that you were paid on a monthly basis. Then that $12,000 tax benefit would be apportioned into $1,000 extra in your pocket every month. Okay, so when you look at what the overall holding costs of property are, if you can get this money back in your pocket, giving you a return, then you're simply maximising that, and you've got more cash flow left over for more properties or a better lifestyle. So hopefully that's helped, guys. Buy new to maximise depreciation, get your tax variation form in place, and you can get that money back throughout the year. Hope that's helped.